Hi, everyone, and welcome to this Portfolio Partners Fireside Chat. Today we have Mr. Tony Bell, who is the CIO of ThinkCell. Tony has been in the industry for 40 years, over 40 years, and has seen a few market downturns over the time, starting at the 1987 crash, which sounds like, a long time ago. But there's a lot of similarities between these market moves. And Tony's here to explain what we've had, what we are seeing today, and what we might be expecting in the near future. Some of you, welcome, Tony.
Thank you, Jim. Welcome to everybody on the call.
Yeah, some of you may know Tony. I'm sure you do from some of our previous webinars and seminars for financial fitness. You may not know he's been running Global Marathon for over 10 years, plus a fund called Global Macro and Global Opportunity. And those funds collectively have won 15 awards, 15 different industry awards for performance over different time frames, which is phenomenal for any fund manager and is a testimony to the experience that Tony brings to this business and the systems that he and ThinkCell have developed for deciding when to buy particular companies and when to avoid them. So, Tony, let's get started with a little bit of the history. How have we done with Global Marathon over the past 1 year and 5 years?
Jim, thank you very much. The performance over 1, 5, and indeed since inception has been very credible. As you said, we've managed to, between the 3 funds, win 12 Raging Bulls. Last year, we were very honored with this year, we were very honored with the 5-year and 10-year Fund Hub Award, the inaugural awards. And the answer to your question, Jim, I'm just going to share up 1 or 2 slides. This graph shows the performance for the past year. You can see that we did around 21%. The industry itself did around 10%. And so we improved on the industry by about a factor of 100%. If we look at it over the past 5 years, the pattern repeats, and indeed since inception. I think for all the participants on the call today, the major focus is not only just the outperformance, but a very key component of this fund, Jim, given its flexible nature, is to be able to manage the drawdowns, in other words, the downturns, in an environment as we see at the moment.
Indeed, Tony. Now, obviously, there's been quite a lot of chatter very recently. Mr. Trump is well known for shaking things up, and I know that you've had to do a lot of thinking about that and what might happen. So, what are your feelings now, Tony, with regard to the way we are currently positioned? And maybe we can use this as an opportunity to just look at how the fund has done against the S&P, because everyone's talking about the S&P at the moment.
Yeah, Jim, I'll cover it in a little while's time, but I think the environment that President Trump has created is a very fractured environment. I think key to bear markets in the past is that all bear markets have really been precipitated by liquidity-driven events. So with reference to the lovely introduction that you gave, I was indeed around for 87. I was also around for 92, 94, 98, 02, 07, 14, 20, and now 2025. The bulk of those bear markets are characterized by a shock to the system, not a recession. Recessions follow. Something has to shock the system, which we'll unpack today, to create a recessionary environment. So in that context, Jim, what we have done in the portfolio in the last quarter has been to fairly aggressively reposition the portfolio. We have taken out a significant portion of the risk. You can see again that we're about half of the drawdown of the market. And the positioning over the past quarter, which we'll cover in the final part of our discussion, has taken Marathon to a position it's never been in 10 years. We hold significant amounts of cash. And I won't give the game away just yet, but we have defensively positioned the portfolio to a level that we haven't seen in the past 10 years. Having said that, what is important is to recognize the reason for the long-term outperformance is really driven by high-quality compounders. And perhaps in the context of the risk management that currently is in play, also just to set the background of why the fund has done so well. I often hear the story that you buy stocks because they're at a discount to intrinsic value. Our approach is very simple. We want to find and have exposure to a range of companies that have the ability to increase their earnings well above what the average company on the S&P has been able to do. So the graph is very simple. If you had invested $100 5 years ago in the S&P, you would have had $200 today. The value accrued for NVIDIA, Eli Lilly, Fortinet are all in the little black boxes. And it's this, the compounding effect of companies in different sectors that have something about their business that allows them to generate this sort of earnings growth that we continue to look for, has benefited the fund very well over the past 5 and 10 years. And in the current environment, we believe prices are starting to radically dislocate from value. And it's in these times where a fund that is a stock picking fund can take maximum advantage of the price downturns we see, but we need to manage the risk in the short term.
Well, that's great news, Tony. So I understand that you're holding quite a high cash position, which would put you in the position to take advantage of the opportunities that are most likely coming in the near future. Although you showed how the fund had declined a little bit over the last few months, but it's very important to keep in mind that Global Marathon has still over 100% for the last 5 years. So it's yeah. If people invested more than 5 years ago, they're still dramatically up on their investment. So yeah,
it's that, Jim, of those returns when you're in this sort. I think what makes this environment very scary for investors is that it's soundbite and headline rich. Today, China imposed 84% tariffs. Last night, President Trump put on another 50. It almost feels like in Afrikaans, they call it a whirlwind, a whirlwind of news. And it's very difficult to get perspective at times like these. But I would just re-emphasize, as an active manager with long-term focus, these moments present us with the very best opportunity to accrue long-term value, because it's in all the market declines that prices dislocate from value. And if our timing and risk management strategies are appropriate for the environment we're in, we pick up the best possible opportunities we can.
Indeed, Tony. And you have a little bit more of a complex theory to show us just now, but the macro time clock that you mentioned, that's something that will be quite difficult for most of us to follow. But it's important that we know some of the more intricate things that you do to manage the money that we have in the fund?
Sure, Jim. I'm just going to call that up quickly.
Yeah.
It's a very simple chart to understand. There are 4 blocks. You have to work out where you are. The horizontal axis is volatility, and the vertical axis is, just think about it as the amount of liquidity in and out of the economies. So what we don't want to see is we don't want to see a dramatic increase in volatility. Since I produced this chart, the little red dot you are here has actually moved right off the chart on the right-hand side. The VIX index, which is an index quoted in America on the Chicago Board of Exchange, that gives the market's representation of where risk is at, volatility is at, has moved from about 16, where we were at the end of last year when President Trump was nominated as the incumbent, or as the incoming president. Jim, we're sitting at just on 50 today, so the scale doesn't even accommodate it. I think the key message for the viewers and participants is we've moved from an environment which was relatively low risk. There was good growth in the US economy, company performances were good, company earnings were at record levels. This tariff story has introduced an element that I last saw in 1987. And what it's done is it's created a significant amount of uncertainty, and with that, a sell-off in the market. So we're literally in the sort of phase 1 of this corrective phase, where the factors that are within President Trump's control have created significant uncertainty around not only economic growth prospects, but also inflation. So this sort of multicolored chart is simply our assessment of where US inflation goes. And the key takeout, Jim, is we don't want to be risk on in an environment where we see sell-offs, liquidity contracting, we see volatility increasing, uncertainty around how much you spend, whether you've got a job, whether as a company you invest or not. And just as a simple calculation that everyone could understand, an iPhone in America that cost $2,000 a week ago will cost $9,000 next week. A Ford F-100 pickup truck that cost $25,000 a week ago will cost $34,000 this week. That is the extent of the tariffs implemented so far. So, Jim, we see a very volatile environment. We've well experienced in managing these environments. And so over the short term, our primary focus in the portfolio is to manage the market volatility, the market risk. But in the process, we have 30% in cash, a level we haven't held for many years. And as I'll show in the final part of our discussion, we've switched to a very defensive positioning, and that allows us to be patient in managing volatility, but also taking advantage of the opportunities.
Well, Tony, that's quite dramatic to think that the VIX is all the way over to 50. Could you please just remind me, did we survive 1987, or are we living in a simulation?
Jim, we survived 1987.
Okay.
Survived 2025. Where it goes to, right, I think, is the subject of the next part of our discussion. But these setbacks or short-term events in the market tend to be quite opportunistic at a time when everyone is very panicked.
Yeah. So it's all about keeping a calm head and taking advantage of those opportunities that are here now and will be coming in the near future.
Yeah.
Okay. So let's have a look then at US spreads, Tony, because you see that as one of the key factors or key indicators of risk. in the corporate
Great.
credit market.
Yeah.
Yeah.
Jim, I do. So to explain to all the participants today how this happens in practice, don't look at just the price earnings multiple or the earnings of the S&P companies. Just think of this in terms of risk, volatility. We've looked at that. And then just think of it in terms of your garden hose pipe. Is it on or is it off? Watering the garden or keeping the tap off? The top indicator has got a very fancy name, US corporate AAA spread. It's simply the premium that the market demands for holding AAA grade, the very best paper in corporate America. These are unquestionably the best credit risk instruments out there. They're better than the US government, strangely. And the market, for the most part, says, we're not worried. These spreads trade at 80 basis points over the equivalent government bond. What we look for as fund managers in this sort of environment is not just the equity market response, but we're quite concerned if we start to see a tightening up. In other words, the hosepipe starts to get turned off in the credit markets, because you then have a transfer of liquidity risk from equities. We saw the prices come down on Thursday and Friday last week after President Trump introduced his fairly unfathomable tariffs, to be quite honest. And we've seen that spike up. You can see on the bottom panel where the VIX is at the moment. I updated the charts just before we started recording this. And you can see from a AAA spread point of view, we're in the danger zone. So
when were we last over here, Tony?
So the danger zone, Jim, was last when Ukraine was invaded by Russia back in the early part of 2022. So in a strange sense, President Trump has declared something of an economic war on China, and the markets have responded with a repricing of risk. The last time we saw spreads breach the top end of the danger zone was COVID, where you had a very similar supply side shock. I think if there's any sort of good news to be taken from the chaos that surrounds us at the moment, is that it has accelerated so much and the equity market has repriced itself so quickly that a resolve is more likely sooner rather than later. I watched the other night, it was Monday night, in fact, when the markets opened. There was a rumor that there was a 90-day hold on all tariffs to be implemented. Many of the stocks that we hold in the portfolio went up 10-15% within a minute. And that's the type of response that you can have in these very volatile environments. So what you can see from the chart is we've already pulled back significantly. We have protected your portfolio through this entire pullback. We started selling in December. We sold a lot of stock in February, well before the tariff announcement. So we have protected your portfolio all the way down. And we now think the market is trying to find the level commensurate with this increased dynamic between President Xi and President Trump.
Well, this is good news from our point of view, Tony. It's certainly, we would hope that Xi and Donald don't take this so personally, that neither of them wants to back down, or at least discuss a resolution. As you mentioned earlier, the Ukraine war was meant to be over by now, but they can't get Vladimir and Mr. Vladimir and Vladimir to chat with each other. So yeah, so it's reassuring that you're on to this, but I think you're also saying that you don't know when this is going to find its base.
Yeah, Jim, the way in which we go about managing a portfolio in this environment is very similar to an airline pilot flying a plane. Portfolio management is a sense like being a fighter pilot or a pilot. you've got an instrument panel, and hopefully over the years we've honed our skills in terms of how to read the instruments. So we're incredibly disciplined with the levels that we trade, Jim. And we look across, unlike, sort of many equity managers in the various interactions I've had tend to just look at the equities versus their benchmark. We're quite globally focused and macro focused. So we look at what we call the sort of the mechanisms through which risk is expressed, either in the currency markets, the bond markets, the swap markets, the equity markets. It all creates a fairly complex picture, but looking at it holistically, you get the signals from various markets. So we spend quite a lot of time looking at levels, and then we're very disciplined in how we trade those levels. I've just given you two very simple indications on the screen. And to give the participants a sense of what we've done in the portfolio, Jim, is rather important. So just looking at what we've done since the start of the year, and this was the last slide to talk to the specifics, and then we can get on to generals. Global Marathon has traditionally been positioned in the US, high growth stocks, earnings compounders, exactly as we showed a few slides ago, where we looked at Nvidia, we looked at Hermes, we looked at Fortinet, and stocks of that nature, Eli Lilly. The position we took in very early January was that we were heading for a storm. And how do you manage a storm? You save the boat. You keep yourself very defensively positioned. So Berkshire Hathaway had never been held in the portfolio. It's now the top holding. We hold over 5% of Berkshire. Why? Because in his wisdom, Warren Buffett had sold the bulk of his equity last year, and he holds a lot of cash. We've moved into stocks like Philip Morris. They're actually up significantly this year. We sold all the high beta, high growth stocks, or the bulk of them. So we've taken a huge amount of the profit that had accrued in the portfolio over the last 5 years, and we banked that. Where did we take the money? We took it into Japan and Europe. We got out of US cyclicals. We went into China, but we hedged that equity. We sold US long duration nominal bonds because we believed that they were at risk for inflation. For the first time, Jim, we bought gold. We bought hedges on the S&P future, and we switched our dollars into euro. So we have done an incredible amount of work in the last quarter, probably changing about 40% of the portfolio to reposition it for a defensive environment where we've now got 30% cash and very defensive equity positioning. The next move we are likely to take is to balance managing the drawdown risk in this tariff chaos to a point. It's very difficult to pick the point, Jim, but my sense is somewhere around another 5 to 10% down on the S&P. We will look to go back into the market, into those growth stocks that we sold in December and February.
That's quite some moving around, Tony, and I'm sure that none of our clients are really aware of how much goes on in the background to make sure that the portfolios do better than the market indexes. And it's incredible to think that the longest term holder of stock in the world, Warren Buffett, has been selling out in his portfolio over the past year, maybe 6 months or a year.
Yeah.
So I'm sure they've still got some core holdings in there, but it's instructive. Once every lifetime these types of things come along. So Tony,
sorry to interrupt, Jim. I think what may be helpful to the participants is you've got to separate the market and market repricing of risk from the underlying economic impact. At this stage, there is no economic impact. if President Trump reverses course next week, we will go back to an economic outlook where NVIDIA, Eli Lilly, Fortinet, Hermes will all do very, very well. I would remind everyone that the guidance that these companies were giving, not only last year, but also for this quarter, was business was booming. The main supplier to NVIDIA has just released results that are 25% higher than the last reporting period. So what we're dealing with is a structural shock to the system imposed by President Trump to achieve some objective. We can all have our theories about what that objective is, but the underlying damage to the economy at this point is rather limited. Unlike COVID, where when we all went into lockdown, we actually had genuine supply side shocks. So this is where the opportunity arises, is we're currently in this phase, but the companies themselves haven't yet started to experience that economic headwind. If they do, of course, we adjust our strategy, but for now, we're just riding out the storm.
Yeah. Yeah, Tony, I think your friend Jim Rickards has made this point a couple of times in the last few days. He simply said that the patient is ill, that being the U.S. government. You know, U.S. government debt as a ratio to as a percentage of GDP is 125%, and that just becomes unsustainable. So he's suggesting that, you know, what needs to happen, obviously, is the ratio of debt to GDP needs to come down slowly. But the problem that I think a lot of people are having is that these tactics that are being used are just like putting a bull in the china shop, essentially, when you need to reorganize the China so that it's doing something different in future.
I think very well. Henry Kissinger, he said, you know, you don't negotiate around the table when everyone is trying to negotiate from a position of consensus. What President Trump is using is called hard power, not soft power. President Biden used soft power. Trump's style is hard power. It's edgy. It's in your face. It's meant to be a sledgehammer. So if you look very carefully at the list of countries that were tariffed, there were 184 odd, of which most of them got a 10% tariff. Those are going to be expunged, I think, quite shortly. Trump's going to want to claim some short-term wins. Where's his real objective? His real objective is China. He's got to get to a point where there's some sort of détente with China. China has been quite threatening over Taiwan. There's been a lot of naval exercise. Not excusing. I'm just saying from President Trump's perspective, he's really created a Henry Kissinger type moment where the cannons that he's firing are tariffs. And what he's expecting in return is some sort of conciliatory move or negotiated move where I think this thing could escalate to currencies. There could be threats of currency decoupling the Chinese yuan from the dollar. The next term that you could hear is currency manipulator. James Ricards wrote an excellent book in 2013 called Currency Wars. That's playing out almost perfectly. His last book was called Aftermath. That's just a bit more of sober reading, but the script is the same. And so I think what we've got to try and do is separate really the economic impact from the political strategy that's been chosen, and manage risk in the short term, but seek opportunity in the long term. Many of the stocks we sold in December, Jim, are down between 30 and 50% already. You know, when NVIDIA drops below 90, I'm interested. We sold it well above. We sold it 40% higher. And for a long-term investor, given the earnings profile of some of these companies, I'm slowly shifting back into buy mode as opposed to sell mode.
Well, this is great news, and we appreciate it, Tony. having been in the industry for as long as you have, and been through a number of market corrections, what lesson would you say you keep learning and maybe learned once again during this period?
It's an interesting one, Jim. I think this is my ninth correction. I think the biggest lesson that I have taken out is to avoid the media hype and try and spend a lot of time understanding how things connect. Markets provide very clear signaling, and I think part of what makes fund management both an honor and a pleasure is to spend time when literally there is chaos around you, trying to find the opportunity in the moment, but being very mindful of managing the perception and the reality of liquidity and the client's perception of risk. I think the hardest thing for a client to do is to be told, stay in the market. And that's the thing I hear most often. I think a sort of much more pragmatic approach would be to find and partner with fund managers that have the experience and the understanding to navigate these territories, and work in partnership with your advisors to better understand what's happening in the management of these very volatile times.
Yeah, well, that's exactly what we believe in, Tony. We have never thought that you just stay with the exact same strategy through thick and thin, but we can't be as nimble as you are on the coal face. So that's the job that we give fund managers like yourself, and we absolutely appreciate the fact that you are ahead of the curve. Like, what would we say? Like a surfer, you're just slightly ahead of the curve because you never know exactly how that wave is coming.
Yeah, it's all degrees of risk, Jim. I was a very average golfer in my day, and I learned that whilst it was very impressive given my size to take out the driver, the results were never good. I would drift a fairway or two to the right or left. And so I learned to moderate my sort of drive, and I took out a 2 or 3 hybrid and got it on the fairway, and I was in play. And I think the key here is to have a very soundly thought through strategy that keeps you in play all the time. We literally, as a team, communicate hour by hour, day by day, to make sure that we're positioning, we're trimming, we're adjusting, and we navigate based on the levels we've spoken about, so that there's a very defined and disciplined approach, and that takes emotion out of the picture. I think also for me as a fund manager, I don't have any PA portfolios. I'm not emotionally driven by these markets. I co-invest with my clients in the funds that I manage, and that gives me a great sense of comfort that my head is clear to focus just on one thing only, and that's the portfolios under my care.
Right. Well, Tony, that's just about reached our time limit, and so we can round it off here. I'd just like to say thank you once again for 10 years of incredible returns from the Global Marathon Fund, which we established with you in 2015. And we're looking forward to the next 10 years of growth. And let's try and get this 2025 behind us. But we know from 1987 and all the other market declines that it always bottoms at some point and then starts off rallying up to the next new level, next new highs. So thank you, Tony, and we really appreciate it, and we'll look forward to the next time we speak on these portfolio partners.
Thank you to everyone for participating.
Pleasure. Have a great week.